You're listening to Capital Topics, episode number 80. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we discuss financial market bubbles, history, and perspective. Enjoy! Good morning, James. How are you today?
I'm very good, François, and how are you?
I'm good, thank you. So I'll start this off for our listeners. Our recent podcasts have addressed the history of market cycles, long-term capital market returns, and asset allocation, reviewing the weights of U.S. equities versus international. We addressed how recent capital market returns have significantly exceeded long-term expected returns, which may lead to lower future returns. The next related topic is about valuations because the markets are now at all-time highs. The barrage of negative headlines is reaching a crescendo. This is September, historically the worst month for markets. We are seeing headlines flat out stating we are in a bubble. At the end of the day, what is critical for investors is how they will manage their emotion in this sea of crystal ball forecasting. We have been consistent in telling our listeners it's imperative they tune out the noise in financial media, although easier said than done. This leads us to today's topic, which is about financial market bubbles, history, and perspectives. So, James, where would you like to start?
Well, thank you for that introduction, François. That really contextualizes well our topic today because really valuations are high by historical standards, so it's a very timely topic. Recently, I read an article in the Wall Street Journal that was written by renowned finance professor William Gutzman of Yale University. And his article was entitled, "Financial Bubbles Happen Less Often Than You Think." And I really feel, François, that sharing his research will be really useful for our listeners, as it's a terrific message to counter all the negative noise in the financial media right now.
Mm-hmm. So for our listeners, William Gutzman is professor of finance and management studies at the Yale School of Management and a research associate with the National Bureau of Economic Research. In 2018, he received the James R. Verton Award by the Chartered Financial Analyst Institute Research Foundation for a body of research notable for its relevance and enduring value to investment professionals. So James, what has the Professor Gutzman research found about financial market bubbles?
Well, he's done a lot of research on this, but I think we should start off for our listeners to clarify what exactly is a bubble.
Mm-hmm.
So Professor Gutzman's research confirms the term bubble was first referenced to a financial crisis originating 300 years ago. With this, in 1711 to 1720, we had something called the British South Sea Bubble. And from this crisis, financial market bubbles came to signify that the prices of stocks were inflated and fragile based on nothing but air and vulnerable to a sudden burst. So that's really his definition. So it's 300 years old. So I quote from his Wall Street Journal article, "In my research on more than a century of global stock market returns, I looked for how often bubbles occurred. I defined them as a rapid doubling of stock prices, followed by a crash that gave back all or more of the gains over the next 1 year or the next 5 years. Looking at all those possible 5-year periods, bubbles only happened in less than 0.5% of them. So 99.5% of the time, there are no bubbles. So they're very rare. So that's really what Professor Gutzman's research brings to the table. Bubbles are very rare."
Wow. James, that has a huge significance for long-term investors. Professor Gutzman writes in his research paper titled Bubble Investing, Learning from History, and I quote, "The broad awareness of financial history seems to correlate with extreme market events. For example, the closest comparison to the dot-com bubble of the 1990s was the run-up in U.S. stock prices in the 1920s. During the 2008 financial crisis, the financial press frequently referenced past bubbles, periods of market euphoria followed by sharp price declines. He is alluding to how the financial media often refers to these extreme market events during new periods of extreme market volatility. If you ask most people about capital market history, they all mention these periods of extreme negative volatility.
And that's really, really true, François. We see that all the time, often with people who don't know much about markets, but they remember all the crashes or all the big negative events. So again, I believe most investors, when they think of financial bubble, they remember the most recent one, which was the tech bubble, and that the dot-com period,
right,
in the late 1990s into March of 2000. So if as everybody recalls, there were many high-flying tech stocks in the NASDAQ index with little or no revenues. Forget about profits. And they reached billion-dollar valuations. So investors in classic FOMO, fear of missing out, recency bias mindset, believed in overly optimistic projections about the scale and sustainability of growth in these dot-com stocks. So again, many of the headlines at the time touted the belief that intrinsic valuation was no longer relevant when making an investment. This time is different, right?
That's right.
So I'll quote Professor Gertzman in his Wall Street Journal article. When the dot-com bubble burst in March 2000, the NASDAQ fell nearly 78% from its peak. Wow. So if you have $100, you got $22 left, right, on paper. So many of the era's highest flyers plunged more than 90%, and then vast swaths of these dot-com stocks simply disappeared.
I would add, James, that bubbles have historically appeared in most asset classes, including equities in the 1920s, in the US, commodities with the uranium bubble, and also in the real estate, most recently with the US housing market in the 2000s. A key point is that bubbles are usually formed because of either excessive monetary liquidity in the financial system and or changes in investor psychology.
Well, investor psychology, nobody can predict that. Again, a reason for not getting caught up in the noise of the moment. So I would add to what you just said, François, by highlighting that Professor Gertzman's research demonstrates that bubbles only happen very rarely. And I quoted the statistics like 0.5% of the time in over 100 years of data. So, but in his Wall Street Journal article, he states bubbles loom large in our historical understanding of the financial markets. They are memorable, they are colorful, they are scary, they raise questions about investor psychology and the madness of crowds. In good times, we worry if we're going to be caught up in the next bubble. And that, in my opinion, François, is where we're at now with markets and psychology. Yep. So from his Wall Street Journal article, and again, I'm going to quote, and I think this is his core message. One of the biggest mistakes an investor can make is to rely on a handful of colorful historical episodes and ignore the long intervals in between. The sequence of quiet gains that stock markets have made over the decades and centuries they have existed. A statistician will tell you that the smaller your sample of data, the less reliable it is for forecasting. So again, particularly when those samples are chosen or cherry-picked because they're kind of interesting.
James, a British financial journalist and author we follow, Robin Powell, has also recently written an article about Professor Gertzman's research. I would like to share a quote from his article entitled "The Financial Bubble Delusion: Why Crash Fears Cost Investors More Than Crashes Themselves." And a quote, "The most dangerous financial advice sounds perfectly sensible. Don't lose money. Generations of investors have followed this wisdom religiously, keeping their savings safe in cash and bonds while waiting for the inevitable market crash. They've successfully avoided every bubble, every correction, every moment of volatility. They've also missed 300 years of wealth creation, making safety the riskiest strategy of all."
Well, François, I think this is really, really well said. And I would add to that the research findings by Professor Gertzman, who examined market data since the 1700s across 21 countries, it really challenges everything investors think they know about crash probability and market timing. So really on this topic of crash probability and market timing, he does surveys in a collaboration with Nobel laureate Robert Shiller. And these surveys consistently show that investors estimate a 10 to 20% probability of a catastrophic market collapse within any 6-month period. He's been doing these surveys for over 25 years. And as we quoted from his Wall Street Journal article, when Gertzman analyzed actual market behavior from 1900 to 2014, examining every possible 5-year window across global stock markets, financial bubbles occurred in less than 0.5% of these periods.
Yeah, Robin Powell has an interesting take on this, and I quote him again. This perception gap isn't merely academic curiosity. It represents the difference between capital appreciation and wealth destruction for millions of investors. Like a smoke alarm that sounds every time you make toast, our crash detection system have become so sensitive to false alarms that we abandon the kitchen entirely, missing decades of perfectly good meals while obsessing over the rare occasion where something actually burns.
Well, Robin Powell is a really talented writer.
He is.
So again, François, in our podcast number 75, we we're covering the UBS's global yearbook return that uses Professors Dimson, Marsh, and Staunton's database. And they also go back to 1900. And so they're saying pretty much the same thing as Gertzman, that the long-term U.S. investor who stuck with a diversified stock portfolio in global markets earned returns of about 9.5% per year. And François, you know, this, as we both know, and many of our listeners know, this happened despite all the historical extreme events such as the crash of 1929, the Great Depression, the single-day loss of more than 20% on the Dow and the Standard & Poor's 500 in 1987, the bursting of the dot-com bubble we've already talked about, the global financial crisis 2008, 2009, and even the COVID meltdown.
Yeah, even the most dramatic single-day crashes prove remarkably rare. Since 1887, the Dow Jones Industrial Average has fallen more than 10% in a single session, exactly 4 times. That's 4 days out of like 34,000 trading session. The market's normal tendency towards gradual investment growth overwhelmingly dominates its occasional spectacular failures.
Yeah, well, it's interesting you highlight that, François, because for me, 1987 was really my first experience living a crash live, and where it lost like 20% or more in Black Monday. And you know, I remember vividly witnessing the biggest large cap stocks, and think like Bell shares trading with a bid ask spread of $3, which is really crazy when you think of it.
Yeah, but that's wild. Today, the spread on a normal trading day is a couple of pennies. So why do you think, James, investors are prone to believe bubbles or crashes are much more likely to happen than it actually does, according to the historical data?
Well, you know, I think my personal answer is that people rush to reading the financial press when markets crash because they want to know more what's going on, right? But, you know, a recent paper published in 2024 by Professor Gertzman entitled Crash Narratives. So his latest research uses artificial intelligence to analyze media content to see how the tone and messaging in financial publications may influence investors during periods of extreme market volatility. So his findings actually show how media coverage distorts the probabilities of extreme events. And again, Robin Powell speaks about this in his article, and I quote, "Newspapers don't run headlines about market rises modestly for the 12th consecutive session, or local investors' portfolio compounds quietly at 8% annual rate. No, drama sells newspapers or attracts eyeballs in the internet age. So compound interest doesn't. And this creates an availability bias. We haven't talking about that often, availability bias, in our podcast. And that's where memorable crashes feel far more probable than boring wealth creation, despite historical evidence showing the opposite."
James, humans are simply not wired to process market history data. Behavioral economics highlights that investors are much more afraid of losses than emotionally attracted to gains. As Robin Powell states, again, humans evolved to survive immediate physical threats, not evaluate statistical probabilities over decades. A 0.5% catastrophe, a frequency, feels meaningless compared to the visceral fear generated by the vivid crash footage from 1929 or 2008. Our brains treat these rare but memorable events as representative samples despite their statistical insignificance.
Well, François, to me, Professor Gertzman's research provides, other really key insights about, during these bubble periods, that they were actually powerful economic impacts that came from all the innovations that were occurring. And you think of the 1920s and the technological evolution during then, or in the 1990s with the personal computer. These historical speculative periods often coincide with genuine economic transformation. The challenge isn't identifying innovation or growth because it's obvious, right? So it's determining which specific companies will survive and thrive. And it requires master stock picking skills that defeat even the most sophisticated investors.
Mm-hmm. Yeah.
So as we said earlier, the dot-com crash destroyed trillions in speculative paper wealth while preserving, the companies that would ultimately dominate the next 2 decades. So you think of Amazon or Alphabet, which was Google, Apple, Microsoft, Nvidia, and other big tech stocks. They peaked in that period of late 1999 into March 2000. They then crashed, and we saw a lost decade in U.S. stocks. But today these stocks are the mega cap winners of the PC revolution that started in the 1980s.
Yeah, James. Similarly, today markets are driven by everything that involves AI, artificial intelligence. While the individual AI companies may turn out to be a bust, the underlying technological shifts will likely be transformational. Investors fleeing the entire sector due to bubble concerns risk missing legitimate wealth creation opportunity.
Well, again, that is the big risk that investors face. So from what I know from my many years of experience in managing money for clients, the true devastation from crash anxiety emerges not during the crashes themselves, but in the periods when investors sit on the sidelines. And, Professor Gertzman's research shows that boom periods are almost twice as likely to lead to further gains as a devastating crash. And this is a really important point. So he states that traditional financial theory suggests markets should become more dangerous as prices rise. But the historical evidence complicates this intuitive relationship. While catastrophe probability does increase statistically during boom periods, it remains remarkably low in absolute terms. So even after markets double, the 5-year crash probability rises from virtually 0 to roughly 15%. So this comes out to about a 1 in 6 chance. So you still have 85% chance that you're going to have a significant gain following this bubble 5 years later.
Yeah. And the mathematics of compound growth makes these timing errors particularly costly. We have highlighted this often in the podcast. And Dimensional has some great charts on trying to time the markets. Robin Powell highlights in his article that missing just the 20 best trading days over a 20-year period typically reduces total returns by approximately 50%. Since many of these best days occur during the volatile recovery phases following crashes.
Well, François, crash avoidance strategies often guarantee missing the very rebounds that create long-term prosperity. And we saw that with Raymond's research on asset classes in our podcast earlier this year. So time in the market matters more than timing the market. Timing involves 2 decisions: when to get out, if you're invested, that is, and then when to get back in. And that's where people can get out. I got out just in time. Yeah, but when do you get back in? Then you mess that up and then you've lost, right? So you must get both decisions right. And this creates a fascinating paradox for investors because during boom periods, you're simultaneously facing peak opportunity and peak anxiety. So markets that may have double face higher crash risks than normal periods. We just saw that in the statistic. It goes from 0.5 to 15%, but they're also more likely to double than crash 5 years later.
Yeah, and this leads us, James, to focusing on investor behavior. The emotional challenge lies in maintaining perspective while surrounded by these intense negative media coverage. Again, I would like to share a great quote from Robin Powell. Professional behavioral research reveals why this paradox torments investor. Rising prices creates cognitive dissonance. We want to participate in prosperity creation, yet everything feels too expensive compared to historical norms. This discomfort intensifies as booms continue, making early exit feel increasingly prudent despite evidence suggesting otherwise. The solution requires understanding probability versus certainty. A 15% crash probability means an 85% probability of avoiding crashes. No rational person would refuse a game offering 85% odds of substantial gain versus 15% odds of temporary loss. Yet, this describes exactly how investors behave during boom periods.
Well, François, it wouldn't be one of our regular podcasts if we didn't come back to a Warren Buffett quote. But this time around, we're going to share something from one of his mentors, Benjamin Graham, and it's a classic quote, from his classic book, The Intelligent Investor, in there which he stated, "In the short run, the market is a voting machine, but in the long run, it's a weighing machine." So, this insight really suggests that catastrophe anxiety, has been around for a long time, and it's going to challenge our long-term investor mindset. And ultimately, if we fall prey to it, it's going to reduce our long-term portfolio returns.
Yeah, financial bubbles grip our imagination. Professor Gertzman research spanning 300 years reveals they are exceptionally rare events. Investors influenced by the financial media are scared into market timing out of fear of losing significant wealth. Robin Powell says it well: the real wealth destroyer isn't market crashes, it's the behavior they inspire in investors. Jason Zweig, in his September 9th article, in the blog The Intelligent Investor, says, "Our emotions don't forecast what will happen, they postcast what did happen."
Yeah, well, that's a play on words, postcast as opposed to podcast. But really, it's all about your emotions reacting after the fact. Again, it's very well said, and I love those quotes. But interestingly, François, what this research by Professor Gertzman really help us with is that look at financial market bubbles as a very rare event, and to avoid the fear that we're going to suffer a catastrophic loss right around the corner due to the market crashing. And we really don't want to be pushed into bad investing behavior and succumb to market timing. So as our listeners know, and many of them comment, we harp all the time in market timing, but we are all tempted, professionals and the client investors. So my final quote today is from Professor Gertzman's Wall Street Journal article, and he states, "Is it possible to avoid bubbles?" And he says, "Guessing in real time whether a stock market boom will collapse is notoriously difficult. In fact, we know the statistics, it's virtually impossible." So again, because you'd have to guess market psychology, right? And
Correct.
it's next to impossible.
So let's conclude here for listeners, James. So a successful investment experience is based on consistently making good investment decisions. This brings us back, James, to the importance of a long-term perspective. And with an appreciation of the laws of risks and returns, I recommend that our listeners always consider their long-term goals, their risk profile, their ability to take risk, and their time horizon when building their portfolios. So I hope our listeners have found this discussion about financial market bubble useful to helping them make smart decisions for their long-term money. Investor must always come back to the perspective of risk and reward and the importance of diversification and asset allocation. This, as our regular listeners know, is core to our investments philosophy. So, James, thank you for sharing your thought and expertise again today.
My pleasure, François.
So that's it for episode number 80 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our expertise in managing your assets, you can reach us by clicking on the Contact Us button, which is located on the Capital Topics homepage and on all our publications. Furthermore, if you like our podcast, please make sure to share it with your family and friends. If you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on October 29th. In the meantime, make sure to consult the Capital Topics website for our latest blog posts. Thank you, and see you soon.